Today, we talk about the 2008 financial crisis explained. Must have. Imagine waking up one morning and realizing the rules of money have changed. Your job feels unsafe. Your savings feel fragile. Your house feels like a liability. And no one can clearly explain why. This is not a movie scene. This was real life in 2008. The year the global financial system almost collapsed. Not because of a war, not because of a natural disaster, but because of human decisions, quiet ones, made years earlier. And by the time people noticed, it was already too late. Today, we are going to explain the 2008 financial crisis, simply, slowly, from the ground up. So by the end, you understand what really happened, why it happened, and why it still matters today. Let's start with a simple truth. Money runs on trust. You trust your bank to keep your savings safe. Banks trust borrowers to pay back loans. Businesses trust banks to lend money. And the entire economy depends on that trust flowing smoothly. In 2008, that trust broke. And when trust breaks, everything freezes. To understand why, we need to go back to the early 2000s. America was in love with houses. Owning a home was not just a dream, it was considered a smart financial move. House prices kept going up year after year, so people believed one simple idea: housing prices never fall. That belief was the seed of the crisis. Banks noticed this trend, and banks love lending money, because lending money is how banks make profits. Normally, banks are careful. They check your income, they check your credit history, they check if you can repay. But something changed. Banks realized they didn't need to keep the loan, they could sell it. So the incentive changed. It was no longer about, will this person repay? It became, how many loans can we create? This is where subprime mortgages appear. Subprime mortgages were home loans given to people with weak credit, low income, unstable jobs, little savings. People who normally would not qualify, but banks approved them anyway. Why? Because they believed housing prices would keep rising. If the borrower failed, the house could be sold. Problem solved. At least that's what they thought. Let's use a simple example. Imagine lending your car to someone who doesn't know how to drive. Normally, you would never do this. But imagine believing cars can never crash, so you lend it anyway. That belief is exactly what banks had about housing. But the story doesn't stop there. Banks didn't keep these loans. They bundled thousands of mortgages together. Good loans, bad loans, very risky loans, all mixed together. Then they turned these bundles into financial products and sold them to investors around the world. Pension funds, insurance companies, foreign banks, everyone bought them because rating agencies said they were safe, very safe, sometimes even labeled as top-quality investments. Here's the dangerous part. Risk didn't disappear, it was hidden, spread across the system, so no one could see where the danger really was. Everyone trusted someone else had checked. That is how bubbles form, not with loud alarms, but with quiet assumptions. For a while, everything looked fine. People bought homes, banks made profits, investors earned returns. Housing prices kept rising. This reinforced the belief. See, it's safe. But then something small happened. Interest rates increased. Monthly mortgage payments became higher. At first, only a few people struggled, then more, then many. People began missing payments, then defaulting, then losing homes. As houses flooded the market, prices stopped rising, then they started falling. That was the moment the entire system cracked. because the system only worked if house prices kept rising. Now imagine this. You owe more money than your house is worth. You're paying for something that keeps losing value. Many people walked away, not because they were bad people, but because the math no longer made sense. And when millions do this, banks get hit hard. Remember those mortgage bundles? Their value depended on people paying their loans. When payments stopped, those products collapsed. Suddenly, assets worth billions were nearly worthless. But no one knew who held the losses, so banks stopped trusting each other. This is where fear takes over. Banks refused to lend, businesses couldn't borrow, credit froze. Think of the economy like blood circulation. Money must move to keep things alive. In 2008, money stopped moving. Then came the shock. One of the biggest investment banks, Lehman Brothers, collapsed overnight. This was huge. It sent a message to the world. No one is safe. Markets panicked. Investors sold everything. Stock markets crashed, and fear spread faster than logic. People rushed to banks. Some banks ran out of cash. Others shut down. Companies couldn't pay workers. Businesses closed. Unemployment exploded. This wasn't just a financial crisis. It became a human crisis. Families lost homes. Retirement savings vanished. Young graduates entered the worst job market in decades. Mental stress skyrocketed. And the worst part? Most people didn't cause it. They were caught inside it. At this point, governments faced a nightmare decision. Let banks fail and risk total collapse, or rescue them using public money. They chose rescue. Governments injected trillions into the financial system. They bought bad assets. They guaranteed banks. They printed money. The goal was simple: stop the bleeding. This decision was controversial. Many people were angry. Why save banks that caused the crisis? But leaders feared doing nothing would destroy everything. They chose the lesser evil. Slowly, the panic eased. Markets stabilized, but the damage remained. Recovery took years. Some countries recovered faster. Others struggled for a decade. Trust in institutions collapsed, and inequality widened. Now, let's pause, because this story is not just about the past, it's about systems. The 2008 crisis teaches us how incentives shape behavior. When people are rewarded for taking risks they don't bear, systems break. Banks were rewarded for volume, not quality. Rating agencies were paid by the same banks they rated. Investors chased returns without understanding risk. Everyone followed incentives. No one felt responsible for the whole system. That is a key lesson. Crises don't come from evil villains. They come from misaligned incentives, from small decisions repeated millions of times. Another lesson is psychology. During bubbles, logic disappears. People follow crowds. Fear of missing out beats caution. And when things fall, panic replaces reason. Markets are emotional, always have been. Regulations were changed after the crisis. Banks were required to hold more capital. Risky lending was restricted. Stress tests were introduced. But here's the truth. Rules reduce risk. They never remove it. Financial systems evolve. New products appear. New risks form. The shape changes, but human behavior does not. That's why understanding 2008 still matters. Because today, you still depend on banks. You still rely on credit. You still trust the system with your future. Understanding its weaknesses makes you stronger. So, what should you take away? First, if something looks safe only because it always has been, be cautious. Second, when incentives reward risk, expect instability. Third, crises come slow to build and fast to explode. And finally, the best protection is understanding. If this video helped you see the system more clearly, support the channel. Subscribe for more simple explanations about money, power, and how the world really works.